Hey everyone, welcome back to the Web3 Daily Report. I've gotta say, it's been a wild 24 hours in the market. Bitcoin and Ethereum both took a hit. The entire crypto market cap shed over 80 billion, and that left a lot of new investors scratching their heads, and even some veterans wondering if the bull run was losing steam. But here's the thing, on-chain data shows this dip was largely triggered by a long-dormant whale who suddenly woke up and dumped a massive amount of Bitcoin. But that's not a huge problem, because we then saw Ethereum and a bunch of other altcoins quickly soak up that liquidity, proving the market's got some serious resilience. So right now, the name of the game isn't panic. It's about understanding the core reasons behind the volatility, keeping your cool, and staying ready for what's next. Alright, let's dive into the hottest topic in the Web3 world today. To be honest, the past couple of days, what's had everyone buzzing isn't some hot new project. It's what some of the oldest whales are up to. Just before the recent market plunge, a Bitcoin address that had been dormant since around 2014 suddenly woke up. This guy, or I should say, this whale, divided and moved over 27,000 Bitcoin to several new addresses, a total value of more than $2.7 billion. This single action, combined with the Federal Reserve's hawkish comments, was the domino that triggered a huge market slide, wiping out over $80 billion. My first thought when I saw this was, this is textbook market manipulation. But have you ever wondered why this whale chose this exact moment to sell? Unlike other institutions or short-term traders, this whale isn't concerned with a few percentage points of volatility. It could have sold at any time. Its actions felt more like a signal, a reminder that even the biggest players will take profits when macro uncertainty increases. It shows us that in the crypto space, the moves of on-chain whales can be a crucial factor in the overall market trend. But it also proves something else. While Bitcoin took a hit, the market's liquidity is still extremely robust. Ethereum and other popular coins quickly absorbed the sell pressure, demonstrating the sheer resilience of the Web3 ecosystem. Alright, now that we've talked about the market turbulence, let's shift gears and dive into some genuinely exciting news. A Japanese publicly traded company named Metaplanet has just been included in the FTSE Japan Index. And this is a massive deal. Think of the FTSE Japan Index as Japan's version of the SP 500. It tracks the country's most elite companies. For a company that's a dedicated Bitcoin holder and constantly adding to its reserves, to be included in such a major financial index, it sends an incredibly powerful signal. First and foremost, this means that traditional funds and pension funds that track the FTSE index now have indirect exposure to Bitcoin without having to buy it directly. They can simply buy Metaplanet's stock. This is a highly efficient and regulatory-friendly way for traditional finance capital to flow into Bitcoin. It's a huge stamp of approval for Metaplanet's strategy, and more importantly, a profound validation of Bitcoin as a corporate treasury asset. In a market as focused on compliance as Japan's, this is a monumental step. Metaplanet announced back in May that they would follow in MicroStrategy's footsteps and make Bitcoin their core treasury asset. And they've been accumulating ever since. Their latest move was to buy another 4.3 Bitcoin for about 260 zero. Well, that's not a huge amount in the grand scheme of things. It represents a persistent and unwavering accumulation strategy. As of today, their total holdings have reached an impressive 141.076 Bitcoin. Their CEO has stated they will continue to use debt financing and other methods to add more Bitcoin to their balance sheet, showing immense confidence in Bitcoin, despite short-term market fluctuations. I believe the impact of this is far-reaching. This isn't just one company's action. It could be a powerful catalyst. When a country with a highly developed and mature financial market like Japan sets a precedent like this, other Japanese and even Asian companies will see that holding Bitcoin as a strategic asset is not only viable, but can also gain mainstream financial market acceptance. This opens a new door for institutional adoption in Asia and provides a strong endorsement for Bitcoin's long-term value. So while we watch the short-term market swings, let's not forget about the long-term bullish trends that are shaping the future. Alright, speaking of institutional adoption, another country in Asia has just made a huge move, and this one is arguably even bolder, almost a little bit out of the box. Recently, a prominent member of the Philippine Congress named Joey Salceda officially introduced a bill called the Strategic Bitcoin Reserve Act. The name alone is pretty impactful, but the core purpose is even more so. It proposes that the Philippine government use Bitcoin to gradually pay down the country's massive national debt. You heard that right, not by printing more money or raising taxes, but with Bitcoin. The bill specifically suggests that over the next 5 years, the Philippine government would allocate 2% of its annual national budget to buy Bitcoin. The goal is to acquire 2,000 Bitcoin each year for 5 years, ultimately building a national strategic reserve of 10,000 Bitcoin. Salceda stated that as a form of digital gold, Bitcoin's scarcity and decentralized nature could become a solid defense against inflation and a hedge against the risks of traditional currencies, offering a new, high-potential growth avenue for the nation's treasury. I think the introduction of this bill is profoundly significant. It's not just treating Bitcoin as a simple investment, it's elevating it to the status of a national strategic asset. Well, when a country begins to seriously consider using Bitcoin to solve its most complex macroeconomic problems, like a sovereign debt crisis, it's one of the strongest possible validations of Bitcoin's value proposition. It sends a very clear signal to the world that Bitcoin isn't just a game for Wall Street elites or tech moguls. It can also be a key tool for developing nations or any sovereign state to improve financial health and seek economic breakthroughs. If this bill passes and is successfully implemented, it would offer a new and imaginative solution for other debt-ridden developing countries. It could trigger a global conversation about the digitization of sovereign assets and ultimately push more nations and sovereign wealth funds to include Bitcoin in their strategic asset allocation portfolios. So, don't underestimate this bill from the Philippines. It could become a major milestone in advancing Bitcoin's global adoption, and its long-term impact is absolutely on par with any major company entering the space. Alright, let's pivot from the grand national level narratives and zoom in on the Web3 space itself, specifically looking at some hard data from the DeFi sector. Recently, the decentralized lending protocol Aave just hit a new all-time record. Its total value locked, or TVL, soared to an impressive $41.1 billion. You might find that number a little abstract and hard to grasp, but what if I told you that this 41.1 billion TVL would make Aave the 54th largest bank in the United States? That'll give you some perspective, and if you include the value of assets borrowed on the platform, Aave's total value actually exceeds 71.1 billion, which would rank it as the 37th largest bank in the US. What does this mean? It means a decentralized protocol, running purely on code without any physical branches or traditional employees, is quietly challenging and even surpassing traditional financial giants that have been around for 100 years and employ thousands of people. I believe this milestone is more than just a victory for Aave, it's a victory for the entire DeFi sector. It proves to everyone that decentralized finance is no longer just a theoretical concept. It's becoming a real trustworthy financial system capable of handling immense amounts of capital. This transparent, efficient, and permissionless lending model is steadily gaining user trust and attracting significant capital inflows, especially amid the current market volatility. The fact that capital is still willing to flow into a leading DeFi protocol like Aave shows that the market's belief in DeFi as the future of financial infrastructure is unwavering, and there's a strong long-term confidence in the sector's potential. This event also confirms that Web3 is achieving true financialization. It's a qualitative leap from the initial hype to the multi-billion-dollar flow of capital we see today. It tells us that Web3 is more than just NFTs and gaming. It's a new financial infrastructure that is slowly encroaching on and replacing the territory of traditional finance. So, when we look at this data, we should remain optimistic because the Web3 story is only just beginning. Alright, speaking of institutional capital, it's not just focused on Bitcoin and Ethereum. Recently, Wall Street giants have set their sights on another rapidly emerging ecosystem. According to internal sources, a group of top-tier firms, including crypto giants, Galaxy Digital, Multicoin Capital, and Jump Crypto, are joining forces to plan a massive $1 billion Solana treasury firm. When this news broke, my immediate thought was that Solana's spring might truly be on its way. This is about so much more than just $1 billion. It represents Wall Street's firm belief in the Solana ecosystem. The main goal of this treasury firm is to specifically invest in and support early-stage projects on the Solana chain, provide stable liquidity for the ecosystem, and build a strong financial backbone by directly holding Solana-related assets. You can think of it as a pilot fund designed to ensure Solana's future growth. Why Solana? I think it's easy to understand. While Ethereum remains the king of DeFi and NFTs, Solana has attracted a huge number of developers and users over the past year due to its high performance and extremely low transaction fees. We've seen daily transaction volumes and DEX volumes on the Solana chain continue to soar, and its ecosystem is expanding at an incredible pace. For these top institutions who are chasing high returns and have a deep understanding of the technology, Solana is undoubtedly the next big investment target. They're seeing its potential as the internet infrastructure of the future and its position as a powerful competitor to Ethereum. The launch of this billion-dollar fund will significantly change the landscape of the Solana ecosystem. It will not only provide much-needed capital to promising projects, helping them grow rapidly, but will also attract more top developers and teams to the chain. It sends a very clear signal to the entire market. Wall Street's smart money is beginning to enter Solana on a massive scale. For Solana's long-term development, this is a huge shot in the arm. So, if you're a participant in the Solana ecosystem, or considering entering, this news is absolutely worth your close attention, because this wave of capital from the traditional financial world could very well propel Solana into a new phase of growth. Alright? After talking about the moves of the Wall Street big shots, let's look at some news that has more of a tech and community feel to it. This story might sound a bit unbelievable, but it's a perfect example of economic principles at play in the crypto world. Recently, Dogecoin's mining profitability has reached a staggering level, even surpassing coins that are primarily focused on mining, like Monero. Its daily mining profits have soared to 2.3 million. It's because of this huge profit incentive that a blockchain project focused on artificial intelligence called Cubic is considering a major strategic shift. The Cubic project has a long-term goal of using decentralized computing power to drive AI. So it's a very hardcore tech project. And now, due to the incredibly high profitability of Dogecoin mining, the Cubic community is holding an official vote to decide whether to migrate their entire network and merge their mining operations with the Dogecoin network. It's essentially a technical all-in. If the proposal passes, Cubic's miners will switch to mining Dogecoin, but will also provide computing power for the Cubic network, giving them a double dose of income. I think this event is significant for several reasons. First, it proves once again that Dogecoin is more than just a meme coin. Its proof-of-work mechanism and huge network hash rate are bringing it real economic value. Its high profitability is not only attracting new miners, but is even luring projects with grand technical visions like Cubic. This shows that a project's economic model and its incentive structure can sometimes be more appealing than the technology itself. Second, this event reflects that the economic interconnectedness between different chains in the pod space is growing stronger. When one coin's mining becomes extremely profitable, it acts like a massive magnet, attracting hash power from other chains. This is a huge positive for Dogecoin. It could gain more hash power support, making the network even more secure. And for Cubic, this might be a shortcut to accelerating its AI vision. It's a fascinating example of an economically driven technical collaboration. It tells us that in the Web3 world, any seemingly insignificant change can trigger an unexpected chain reaction, and these reactions are often driven by the most fundamental principles of economics. Alright, after talking about tech and community, let's shift our focus to the United States and discuss politics and regulation. Recently, the world's largest stablecoin issuer, Tether, the company behind the USDT, made a very notable decision. They hired former Trump administration advisor Bo Hines to serve as their head of public policy in the US. When this news came out, I thought it was pretty interesting. It sends a very clear signal that Tether is serious, and I would even say urgent about strengthening its communication with the US government and the regulatory bodies. As a former key figure in the Trump administration, Bo Hines not only knows the ins and outs of Washington's political machine, but also has an extensive network. Tether's move is like bringing on a heavyweight coach for the company's political game in DC. His main job will be to handle lobbying efforts, manage relationships with politicians, and secure a more favorable position for Tether on the policy front. You might be asking, why would Tether do this? The answer is simple, because they're just too big now. Tether's market cap has already exceeded $100 billion. And a significant portion of their reserves are in US Treasury bills. This makes Tether more than just a crypto company. It's a major global financial player that's deeply intertwined with the US financial system. This status naturally attracts intense scrutiny from US regulators like the Treasury and the Fed. They need someone who understands both crypto and politics to ensure the company's compliance journey in the US is smooth and successful. Furthermore, Tether's choice to hire someone with deep ties to the Trump camp is a political statement in itself. Trump has shown a relatively friendly attitude toward crypto during his campaign, even publicly expressing support. This indicates that Tether is actively seeking to build a good relationship with a potentially incoming administration. I think this move symbolizes the rapid convergence of the crypto world and traditional politics. As crypto assets go mainstream, the companies behind them must start acting like traditional financial giants, actively participating in political maneuvering to secure a greater future for themselves. This, to me, is a sign of the entire Web3 world's maturation. Alright, after discussing the political moves of the stablecoin giant, let's look at some even more significant news from inside the US Congress. Recently, the US House of Representatives passed a bipartisan bill, and the core purpose of this bill is to require the Federal Reserve and the Treasury Department to conduct a full and formal audit of stablecoin issuers that are deemed systemically important. My first reaction was, isn't this bill custom-made for USDT and the USDC? Because in the current market, no other stablecoin comes close to their scale. The passing of this bill signals that the US government is directly intervening in the core of the crypto space in an unprecedented way. The Fed and the Treasury, the two central powers of the traditional financial world, are now legally authorized to publicly inspect the balance sheets of stablecoin giants like Tether and Circle. They're not just checking the quantity of their reserve assets, but also the composition, quality, and the liquidity. I think this bill is a classic double-edged sword. On the one hand, it's a huge shot in the arm for the entire crypto market. If the Fed and Treasury audits prove that the stablecoin's reserves are real, transparent, and fully backed, the credibility of USDT and the USDC will reach an unprecedented level. This will greatly boost investor confidence and attract more institutional and retail capital into the stablecoin market. This is absolutely a huge long-term positive for the development of the entire Web3 ecosystem. But on the other hand, it also means the Web3 world is slowly being tamed by the traditional financial system. The US government is using legislation to bring these decentralized financial tools into their familiar regulatory framework. This means that, in the future, companies like Tether will not only have to face market competition, but also continuous scrutiny and regulation from the Fed and the Treasury. This will bring immense compliance pressure. But at the same time, it will accelerate stablecoins' journey into the mainstream financial world. This bill, I think, is another landmark event in the collision between the Web3 world and the traditional financial system. It tells us that the future of crypto will inevitably be deeply integrated with the traditional world. Alright, that concludes today's Web3 Daily Report. If you found it helpful, please remember to hit that like button to support us. We are here every day to filter the most valuable and wealth-relevant news from the Web3 world for you, hoping that this curated content can help you make more rational and informed decisions on your Web3 investment journey. Additionally, I've prepared exclusive registration links for major exchanges in the comment section. These are high rebate offers we've secured for our fans, hoping to help you save some costs on your investment journey. Let's stay rational, move steadily, and get rich slowly together in the Web3 world. May every one of your crypto assets grow steadily. We'll see you tomorrow.